Welcome to Money Markets with True Potential. Today we'll be looking at what was behind the strong market moves yesterday, and also look on the inflation data print which came out in the US yesterday. Following the turmoil we have seen in the markets in general over the past couple of days, yesterday was a calmer day. We saw a good rebound in risk assets and equity markets in general. What's been behind this rebound? Again, it's digestion of what has been committed by the US regulators and the Federal Reserve over the weekend. Markets got time to digest what has been put in place, the guarantees and the depositors' guarantees which have been placed not only for the failed bank but generally for the wider US banking and financial systems in general. So again, it eased the fear that we are not running into the likes of global financial crisis back in 2008, where the banking crisis was, we saw a number of bank runs in 2008. So I think we may have averted that. The actions taken by the regulators have stemmed that flow and reverberated the confidence in the US banking financial system, banking system overall. We also saw US inflation coming out yesterday, again continuing the trend what we have seen over the past couple of months, slowing inflationary pressures. February number came at 6% year on year versus 6.4% in January. What's been behind that? It's been again energy prices. Petrol prices were down around 2% over the month, while they were up around 1.5% in January. So in general, also we saw food prices coming down, but on the flip side, we saw some pickup in shelter or housing related inflation. That has been, we expect that to continue trending down over the next coming months. So what it means for you and your investments, we expect the central banks to in coming weeks to have a little bit more measured approach to interest rate hiking cycle there. Maintaining the financial stability is an equally important tenet of their mandate. A couple of weeks back, markets were expecting a lot more hawkish and higher interest rates, but going forward, we expect central banks this week and next week to have a little bit more measured approach to raising rates. We expect, and markets are expecting, around 25 basis points hike in next week from the Federal Reserve in the US. Similar approach we will expect from ECB this week, and probably from Bank of England next week as well. So all in all, again, a little bit more measured stance means that although the volatility in the markets may persist, but it sets a bet overall that interest rate may not be able to raise as high as previously expected, which probably provides some relief to interest cost burden, household burdens in general. But for now, we will leave it there, and thank you very much for watching Money Markets.